Hey, let's get rolling in here today. We had a supply demand report out, and we mentioned in yesterday's daily report that if we had a bullish surprise, it maybe could be on wheat, a bearish surprise would be on beans, and thought corn could fit right in the middle. And at the end of the day, that's really kind of what happened. The first thing what got our attention on this report was the top line of the USDA's comments on they acknowledged a Russian invasion on Ukraine and what it is doing towards Ukraine production. And what the USDA did today is they lowered Ukraine's production. Last year on corn, it was just over 1.6 billion bushels. Now they're dropping it below 800 million. On the wheat side of it, a year ago, they produced 1.213 billion bushels of wheat. Now it's going to drop down to around 790 million bushels. What the USDA is saying, this war in Ukraine is going to drop corn production by almost 50% and wheat production about 30%. We think that's important to keep in mind as we look through the remainder of the year, as much of the war is really priced into the market. Let's look at the corn side of it, and our focus is really just on the ending carryouts. There's no sense nitpicking yield or supply demand tables in here. Let's just cut to the chase and get to the ending carryout. And new crop corn ending carryout in the U.S. is forecasted at 1.36 billion bushels, down slightly from a year ago and up a little bit from 2021. As you can see, 5 years ago, our carryout was up over 2.2 billion bushels. As I look to the chart on the right, we've got world ending carryout, but this is world minus China. I think it's better off to look at this data as we move ahead than what it is including China, because China is such a wild card out there. As you can see, world carryout, though, is going to be increasing now for the second year in a row, and it's getting back similar to the levels that we saw in the 2019-20 marketing year. Even though U.S. carryout levels are down, these world values are starting to creep up. So when we want to look at a weekly chart on corn, we're just going back the last 5 years. And as you can see in 21, we had that big surge to $7.50 and then had to push back up to $8 right now. But if we take a step back and just look at the ending carryout level projections, both from a U.S. and a worldwide standpoint, we could easily see corn settle back down to $6, and on a negative situation, eventually get down to a $4.50 to a $6 trading range. We're not saying that's happening in here today. We're not saying that's happening in here this next week, but just with a little bit better crop, a little bit softer demand, all of a sudden you have ending carryout levels start to jump back up. Conversely, any sort of crop issue surely justifies these prices and where we're sitting at right now on the weekly chart. As we flip over to beans, it's really a fairly similar situation here. U.S. ending carryout up at 310 million bushels, a slight increase from last year. We're getting a bounce back on world ending carryout when you minus China, near 2.5 billion bushels. This is similar to both the 1920 and 2021 marketing years. As we look to the weekly chart on soybeans, you can see back in 2021, we spent time, you can look at this $11 to $13 range in here as kind of a midpoint. Therefore, if we don't have crop issues and this crop gets a little bit bigger, we probably got to settle back closer to $13. Again, just like corn, a lot of weather premium is really placed in the bean market when we're looking at front month futures close to $17 and new crop futures up around 15. As we get to wheat, though, we think this is where the bullish story is at. You can see U.S. wheat carryout levels have continued to decline, down at 619 million bushels. And the big news is over on the worldwide basis, as we got world minus China wheat carryout down around 4.6 billion bushels, getting a sharp decline over the last 3 years. As you look then to the wheat prices where we've been at over the last 5 years, you can see this market has exploded higher, and that 1334.5 blue line up on top was the all-time high set back in 2008. As we want to wrap up in here today, we just think that there's a number of things to keep in mind. One, we've often talked about a box where the USDA wants to put their ending carryout, and when you look at these figures in here on new crop corn, beans, and wheat, it really fit into that box. Wheat was probably at the lower end of it, where corn and beans were more mid-range. One thing that stuck out on the yield side of it is the USDA came in with a 177 yield. That compares to the Outlook Conference at 181. On the bean side of it, though, they use that Outlook Conference yield at 51.5. Again, we're not going to debate too much on what the USDA has on the yield. We are off to a little bit later planting, but it is really 4 bushels an acre below trend. The next thing we need to ask ourselves is on this report is there enough to break this thing out, okay, out of our range, whether if it's lower or higher. When you look at the markets higher moving here today, our thinking is the report was not bullish enough to break beans out to the higher side. Unless we have weather, it probably doesn't do it on corn. But this wheat deal puts a lot of uncertainty in things right now. As we look ahead longer term, though, our thinking is the world's going to overproduce $7 corn, $13 beans, and $10 wheat. Okay, or wheat you can put $11 or $12 on there, but there is the price incentive, okay, to overproduce, and that is not going to go away. We can have crop issues out there, but at these levels, it encourages production and discourages usage. We think as you get the crop planted, we got to be a little bit more aggressive. The other thing we're going to start doing is looking ahead to the 2023 crop. There are some good values with corn above $6.50, beans above $13, and then when you get over to the wheat side of it, July 13 Chicago wheat is up at 11. So we may have to start looking ahead that far. We want to wrap up though today as we think in the ag market in here, specifically the grains, that's been a really supported by the speculator and an inflation bet. Okay, inflation's at a 40-year high, over 8%, and investors are really struggling to find places to put their money. I mean, look at the tech stocks are getting their ass kicked. I mean, Netflix is down almost more than 60% on the year. Everyone who wanted to go in the crypto market is starting to get beat up. Gold hasn't gone up and been that inflation hedge in here recently either. And so if you're really trying to protect money when you're looking at inflation, there's really only 2 sectors to go towards, the energy sector and the agricultural sector. And we think that's where a lot of this money flows come in and has specifically supported the grain markets. And that can stay in here, continue to hold these values. But if that starts rolling away, we are going to extract some premium out. And if it comes at the same time that we raise a bigger crop, we're probably going to go down further than what you'd expect. Conversely, though, and we're seeing this with wheat right now, if there is the weather story, if there is the bullish weather bet going out and on wheat with the issues in Europe, you're seeing speculators flock in here right now, and that's where you're getting this latest push on the wheat side of it. We fully expect things to stay volatile in here, but we have to tell you, when we look at this corn and soybean report in here right now today, we don't think that these current supply-demand numbers justify these current price levels we're staying at. We're going to look to be a little more aggressive with some price protection over the next couple of weeks as long as we get this crop planted. Any questions or suggestions on an upcoming webinar, feel free to give us a call. Have a great day.